A very good afternoon, good morning. Welcome to the FX Week Ahead live market analysis. I do hope everybody is doing well. Looking forward to taking us through the markets and just really explaining what's going on. There's a number of moving parts and I need to make it clear what's going on so we can see how markets might move moving forward. These are very tricky and volatile markets, so be very shrewd in them. They also can provide opportunities once we see the clear path ahead. Running through some of the major moves we've seen in oil markets, gold, silver. We'd also be looking at US stocks as well. Don't forget, as we look at different entries, exits, the whole idea of this webinar is that we're looking at the major different instruments from a professional trading perspective. So I'm going to show you what I'm looking at. The only thing to be aware of is I'm not giving an invitation to trade, and in these kind of markets, they're so volatile and can change so quickly. We need to be, really keyed into the main story. It's just not a signal trading service. Those of you who attend this webinar regularly will be aware of that. Now, without further ado, let's get stuck straight into what's going on. Now, key thing to be aware of is the Fed's balance sheet rose for nearly $300 billion last week as there was a big liquidity crisis. And the big story that's driving markets is the fact that the Silicon Valley Bank collapsed and then was supported by the Federal Reserve. Credit Suisse looked like it was going to collapse, got some support from the Swiss National Bank, now has been sort of forced into a takeover by UBS, its biggest rival. And these liquidity concerns, markets have been very concerned that they're going to result in contagion going through the whole banking sector. So similarly to how the global financial crisis worried markets, that's what markets are worried about now, is that there's going to be another global financial crisis, similarly to the crisis that was in the banking sector around 2008, 2009. Now, the thing to be aware of is liquidity is a very rare thing when you need it the most. And that's what investors are suddenly worried about, is that they want to take their money out of banks, but what happens if the banks don't have the deposits to pay them back? And that's a very serious problem because banks don't have at hand all the money that's deposited in them. They obviously make money by lending out the money that's been deposited to them, which is all fine as long as they can, depositors don't ask for the money all at once. Whereas a Silicon Valley Bank, they had a sudden influx of depositors wanting their money back, but because the bank had bought some normally very safe US treasuries, because they had to sell those treasuries before they matured, they were having to sell them at a loss. And the losses grew and grew and grew until they were actually losing money much more quickly than they expected. And when investors are concerned about their money, they want it even more urgently. And so that prompted the collapse for Silicon Valley Bank. And then Saudi National Bank said that they weren't going to give any more money to Credit Suisse. And that prompted a crisis in confidence that ultimately led to Credit Suisse being taken over by UBS. So the security of banks is a major issue right now. Inflation is expected to fall quite sharply now because of the ability for banks to provide credit will be severely hindered now. Because of the unwillingness of banks to be put in that situation, they will be very reluctant about particularly lending out risky investments and risky money to high-risk creditors. So credit will become much harder to come by, and that should impact inflation moving forward. So we should see inflation pressures falling. And one thing to note is, if you haven't seen this, do see it. The Federal Reserve interest rates, about 2 weeks ago, the peak rate for the Federal Reserve was expected to be around 6%, right? It's at 4.6%. Now, short-term interest rate markets are seeing the Federal Reserve cutting rates nearly by 100 basis points this year. So markets have gone from expecting the Fed to keep hiking to now expecting the Fed to cut dramatically as we head into the end of the year. So that's how drastically markets have changed over the last sort of 10 days or so. Now, the way that's impacted markets has been quite pronounced. We've seen US equity markets falling lower, the DAX, Euro stocks, FTSE 100, China 50, all moving sharply lower. Now we're starting to see some stability come into the market. Now, whether this stability lasts or not, we'll have to see. But with the Federal Reserve banking up the Silicon Valley Bank, with UBS making a takeover of Credit Suisse and the Swiss National Bank banking up and providing liquidity for Credit Suisse, that's stabilized markets. So we can see the equity markets in Europe are positive for the day, US equity futures markets just turning positive for the day. So risk is turning more positive right now. Now, looking at gold and silver, they've been on a rip higher. And the reason gold and silver have been on a rip higher is because when you have real yields falling and the dollar falling together, that really supports precious metals. If you haven't seen this before, let me show you. So if you see on this chart here, I'm just going to take silver off for a moment. But the gold level is gold. The green line is the dollar index, and the blue line is a TIPS, which is the Treasury Insurance Protected Security. And this is a proxy for real yields. Now, the beauty of the TIPS is it's updated in the US session. Real yields is only updated once a day. So we're using TIPS as a proxy for real yields. And yields at the moment are falling dramatically. Why? Because we're seeing 10-year bond yields fall, but inflation expectations are remaining elevated. So that hits real yields sharply lower. So when we see real yields fall and the dollar fall, do you notice how we see gold rise sharply? When you have the real yield falling and the dollar falling, gold rises sharply. When you see, and you can see it similarly here in 2010, real yields falling, dollar falling, gold moving up sharply higher. When you have real yields in 2020, real yields moving lower and the dollar moving, gold moving sharp. Now look what we've got here. We'll just drop down to a smaller time frame. You see here, we've got real yields falling since the start of the month, the dollar falling, and that's just causing gold to surge. So gold at the moment, remains a buy on the dips, very elevated, and it's just hit that 2,000 big round number. So it's just hit that key resistance area. But at the moment, any deep dips down to 18, 1900 remain buying on the dips as long as the situation remains with real yields falling and the dollar falling together. Oil markets have been hit significantly. Now, I'm just going to go to my preferred chart for that. Now, if you look at oil markets, you see we've just broken out of this sort of near-term trend line. Okay. Now, let me just want to show you this. Oh, hang on, just want to show you something. There we go. Hopefully that. Okay, let me just. Right, let me just change this so I want to show you something here. Okay, I can't quite show you what I want to show you, which is a little bit frustrating. Let's see, it may turn up now. There we go, let's have a look. Yeah, okay. There we go, right. That's what I want to show you. The 100 and 200 exponential moving average is just sat around this level. So for some reason, my charts is not. We'll just go back to the spot. Let's see that. There, that's it. Finally got that right. You see, oil's just fallen to this key support level around that 65-70 region. Now we had a break of this sort of Harami inside bar and this coiling price action. And the reason oil markets have fallen so sharply lower is because investors are thinking, okay, if demand's going to be hit, if the US is going to head into a recession, if there's banking crisis, then oil is not going to be as in demand as it has been previously. If you look at the behavior of oil prices back in 2008, 2009, to see how oil fell so sharply lower, right? From $150 a barrel all the way down to about $33 a barrel. And that was in the global financial crisis. So investors are sort of thinking, oh, hang on, banking crisis, short oil. Now the fundamentals for oil are really quite good. There is still a decent demand for oil, and there is expectations that oil demand will pick up. So what we have to be conscious of here with oil markets is that the second half of the year sees a bounce in oil. So if risk returns, this is a great place to define and limit risk. So you could have a short-term, trading opportunity would be just having your stops underneath that 60 region. And if risk returns positive, then oil markets can move back up towards $90, $100 a barrel. A number of analysts have oil at sort of $85 to $95 a barrel heading into the second half of this year. Just be aware of that. And if this obviously closes positively for the month, then you've got a false break of these inside bars, which is a very sort of bullish technical setup. So yes, oil, this is not one to buy now, but if sentiment suddenly changes, then we would expect upside in oil markets. So just to be aware of that, but that's what's going on. So in terms of the week ahead, there's an awful lot of significant meetings this week. The Federal Reserve will be the most significant, but we're going to go through what's going on with the other markets as well. So let's just run through. So not much today. Got President Lagarde speaking, but remember there's a lot of the fallout crisis regarding the Swiss National Bank and Credit Suisse and UBS. So expect more conversation from ECB President Lagarde, not expecting anything significant from her. Canadian CPI data won't be as important as it would have been previously, just because the focus is on the central bank monetary policy. But obviously, if inflation starts moving higher, that puts pressure on the Bank of Canada to be less likely to cut interest rates. But at the moment, CPI ahead of the Federal Reserve meeting is not really going to be so significant. Similarly, in the UK, yes, UK inflation is still very, very high. Look, the headline is expected to go to 9.8%, just falling from 10.1%. But this very high inflation in the UK is not new. It's not a surprise. And if it's a little bit of a surprise to the upside or the downside, it's not going to make that much difference, because investors are now expecting the Bank of England to be far less aggressive in the interest rate expectations. If you look at the Bank of England now, markets are expecting this probably to be on hold. It's 50% chance of on hold, 50% chance of hiking by 25 basis points, and markets are looking for potentially, if they hike by 25 basis points on Thursday, a rate cut into the end of the year. So, what's expected for the Bank of England is going to be heavily impacted, not by the inflation print that we have on Wednesday, not really a tradable opportunity in my opinion, will be the Federal Reserve meeting that takes place 6 o'clock UK time in the US. This will be the significant meeting. Now, we've already discussed as we started this session that they may well be much more reluctant to hike interest rates. If we take a look at the short-term pricing, we can see the Fed's expected to price out, anything like terminal rates above 5%. They're expected to indicate rate cuts into the end of the year. So the question is, do they? And if the Fed indicate a pause, or they hike by 25 basis points and then signal a cut, then I would expect US equity markets to rally sharply higher. But there's one condition. The only condition they won't is if the banking crisis is seen to be continuing to pick up speed. So as if the banking crisis is contained, and that's not a big worry to markets, and the Fed announce a pause, then I would expect a good significant upside in US stocks. And that will also play out to European stocks as well. So what the Federal Reserve do will set the tone for the rest of the world. Now, the ECB, they hiked as expected by 50 basis points in their last interest rate meeting. They said they would and they did. But this is the first kind of meeting that we're going to get from a central bank that is really going to set the tone for the rest of the world. So what's if the Fed doesn't hike at all, right? That could worry markets a bit, you see, because markets might think, oh, why is the Fed not hiking? What do they know about this contagion risk? So what I'm expecting them to do is hike by 25 basis points and then announce a pause, that we're going to see how the current crisis develops and see whether it sort of cascades through the economy. There's certainly going to be a credit crunch coming up, and banks will be much more reluctant to issue credit after the Silicon Valley Bank crisis, after the Credit Suisse crisis, after First National Bank, and the difficulty that banks are in. They're going to be very careful about interest, offering credit. That is deflationary. So some of the Fed's work will be done by the banks now. And so what we have to see, what do the Federal Reserve say? Are they, quite confident maybe inflation is going to be managed? If they say we've got to keep hiking, they hike by 50 basis points, if they sort of maintain a very hawkish stance in the face of the banking crunch, then you could expect US stocks to fall very much sharply lower. That will then set the tone for the Bank of England on the Thursday. Thursday, Bank of England meeting 12 o'clock UK time. Now, the last two people that went for a vote, unchanged vote cut, was Dinger and Tenreo last time. They're the two doves from the Bank of England. If you just take a look here, you can see the last two decisions. Dinger, Tenreo, they voted for interest rates to remain at 3.5% on the February meeting. Everyone else wanted a 50 basis point hike. Like Catherine Mann is one of the hawks. So in a prior meeting, when it went up 50 basis points, Catherine Mann wanted it to go up by 75 basis points. Last time she dropped down to 4%. So now you've got 7 members who voted for a hike, 2 members who voted for unchanged, Dinger and Tenreo. So to get a tradable opportunity in the pound, what we want to see is more members moving over to Dinger and Tenreo's side. So if we had, like 6-2 and no rate hike at all, say we had a unchanged interest rate move or a fall in interest rates, then I expect euro pound upside. So what I'll be looking there is see what the Fed do. If the Fed announce a pause, then I'd expect that to flow over to the UK. You'd expect the Bank of England to offer a pause as well. If the Fed hike, then that makes it a bit easier for the Bank of England to hike interest rates. So what we're looking for is a pause, and you'd expect the euro to gain against the pound. That would be my choice. Euro pound, because we've got similar outlook for the Eurozone and the UK, really. And we're around that 200 exponential moving average. So if we got a very dovish decision, I'd expect euro pound upside, and that 200 exponential moving average is a pretty decent area of support, and that's also coming along that sort of trend line, just moving along the bottoms from July 22nd and December 22nd lows. So that's a decent level of support we're approaching. So that's sort of definitely worth looking at as we go to the UK. Now, Swiss National Bank interest rate decision is also going to be interesting. They too, if you look at their positioning, and this is very helpful from a financial sources interest rate probability tracker. Very helpful tool here. You can see that it's been all over the place what's expected, but now investors are currently expecting a interest rate move of 25 basis points, 88% chance of a 25 basis point rate hike. Now, they're not as high as many other central banks. They're only at 1%, so they've got a bit more wiggle room. But if they announce a pause as well, then it wouldn't be a surprise to see a little bit of Swiss franc downside. So depending on, you know, what we could see there is if there's a currency that has strength on the day, you could look to pairing the Swiss against it if they don't hike interest rates. Now, looking at the Swiss more generally, the Swiss franc, what you can see is because of the tie-up between UBS and Credit Suisse, that banking crisis that's come out of Switzerland, you can see that last Wednesday, when the crisis emerged, we saw a heavy sell-off in the Swiss franc. Now, that's a big concern for Switzerland, but that seems to have stabilized now with Credit Suisse being taken over by UBS, and there's even talks of Credit Suisse being nationalized. So I think this will steady, but just be aware that the Swiss franc has been struggling recently with the Credit Suisse woes. So a negative story for Credit Suisse is also negative for the Swiss franc at the moment. And you can see that's in contrast to the yen, whereas the yen Wednesday last week, you can see that gained sharply higher. So you'd expect the yen and the Swiss franc to gain sharply higher in risk-off moves, but because of the Credit Suisse issue and the proximity of the Swiss franc with the Credit Suisse bank, obviously because they're in the same country, that's why we saw downside in the Swiss franc. So there is a little bit of weakness going on there in the Swiss franc, and that could be accelerated if the Swiss National Bank don't hike by 50 basis points on Thursday. That's what's expected. Now, short-term interest rate markets are only pricing in 88% chance of 25 basis points. So be aware of that. So if they hike by 25 basis points, it won't be a surprise. Even though the forecast is 1.5%, 88% chance is seen of a 25 basis point hike. So a 1.25% hike won't be a massive surprise, and it won't be tradable. The tradable opportunity, if it misses by, if they don't hike at all, that would be Swiss franc selling on the day. We then get to Friday and got a series of PMIs coming out for Europe and some Fed speakers coming up. Whole range of PMIs. Now, for the UK data and the European data, let's take it separately. So first of all, UK data, look for that to be in line with what happens on the Bank of England decision on Thursday. So if it's a very dovish decision on Thursday and then we get a miss here, you might get another flush higher in the euro pound. In terms of the Eurozone data, ECB hiked by 50 basis points last week, as expected. But if you get a big miss here, then you could easily expect some euro downside. So watch out for that if we get that scenario of a big miss in the Eurozone data. And a big miss in the Eurozone data will be if we see markets coming in below the minimum expectations. So remember, you get the French data first and then the German and then the Eurozone. The market starts to move from the French data. German data is the most influential. By the time we've had the French and the German data, the Eurozone is not a surprise. So look for the French data. And again, depending on what happens with the UK, you could look at maybe if it's a good print to the upside, I'd look at Euro US dollar, depending obviously what the Federal Reserve do on Wednesday, but I'm expecting them to be more dovish. So you'd expect Euro US dollar upside if we got a big miss here. Or if we saw like the UK having a very dovish approach, then we could look at Euro pound upside if we get a big surprise to the upside. And the big surprise to the upside would be anything above 52.5, 54.5, 50.6 for the headline. And similarly for the German data, anything above 52 and 48 for the headlines. that will be a surprise, and you expect potentially euro pound upside. But you have to weigh that in balance in terms of what's going on with the Bank of England decision. Yeah, hi Abraham. No worries. I think there was an issue starting the webinar today. There was I think a link dropped out and then dropped in. I had to restart it, so I think I think some of it wobbled in that. PMI prints will be important. If we start seeing significant slowdowns in the US PMI prints, then we'd expect that to be supportive of stocks, because it means the Federal Reserve should be less hawkish. So the best opportunity would likely come from a miss in expectations, anything below 50.3, anything below 47. That should be supportive of US stocks to the upside if we got a big miss. If it's a really big beat, I wouldn't expect that to move markets much. The best opportunity would come from a big miss, but obviously you have to weigh that in light of what happens with the Federal Reserve on Wednesday. It's impossible to stress how important the Fed meeting is on Wednesday. That's what's really going to set the market. Remember, we get those economic projections on Wednesday as well. That's the dot plot. Remember, the prior dot plot for December was a median rate of 5.10%. So you can see already that short-term interest rate markets, they see a terminal rate of like 4.8%, 4.85%. So short-term interest rate markets are saying there's no way the Fed's going to 5.10%. And remember, just 10 days ago, this terminal rate was expected to be around like 6%. It was about 5.69%, and then there was speculation that it would go up to 6. We're now looking at the end of the year of 3.90%. So very, very significant. Okay, folks, that is all. Keep your eye on the Federal Reserve today. Remember, banking risk. If there's more concerns about banks being unable to pay back depositors, expect that to hit risk very sharply, regardless of what the Fed do. The banking crisis will trump the Fed policy in the near term. Eventually, the Fed policy will come back round, but in the very, very short term, expect near-term banking drama to drag on sentiment. At the moment, the market is saying we're relieved, right? Use the VIX as a shorthand to see whether the market's scared or not. So if you see the VIX moving higher, the volatility index, this is just showing you how many S&P 500 traders are buying put options. And a put option is when you're expecting the value of the S&P 500 to fall. And you only buy a put option when you're expecting the S&P 500 to move lower, right? So you can see when the VIX moves up, when the S&P 500 goes down. So when the VIX goes up, S&P 500 goes down. When the VIX goes down, the S&P 500 goes up. You see, the VIX goes up, the S&P 500 goes down. If the S&P 500 comes down, you'd expect the VIX to rise again. Equity markets this morning are saying, okay, we're reasonably reassured. The Fed's backing up Silicon Valley Bank. JP Morgan and a few other banks were looking at First National Bank. Credit Suisse is being backed up by the Swiss National Bank and probably being bought by UBS. UBS have put in an offer for it. And as a consequence, we're seeing reversal in European equity markets, and we're seeing risk markets turn positive on the day. Abraham, I've got a question from you. Did the banking crisis bring in all the risk of financial markets? Yes, Abraham, exactly. It was all to do with this financial crisis. Remember, it really sort of came on the Thursday and Friday about 10 days ago. And you see how equity markets started moving so sharply lower, right? And then it was the Wednesday. So remember, in the UK, we saw Friday on the 10th of March, equity markets selling over the crisis over Silicon Valley Bank. Then Monday, we saw more selling. Then Tuesday was a little bounce. Then Wednesday of last week, we had the Credit Suisse crisis. Then more selling, more fear. And now we're seeing a little bit of a bounce, but fear is reigning. And investors are remembering the global financial crisis, etc., etc. So this was all, yeah, we already priced in the 25 basis points. Yeah, maybe, but what we haven't priced in is the forward guidance. So there's massive uncertainty. The key thing to watch on the Fed is forward guidance. So what do the Fed say about this? Yeah, okay, 25 basis points. You see from that Friday, a 25 basis points priced in. Fair enough. And we can see the current rate is 4.625. 25, there's only 50% chance it's priced in, Abraham. You see, there's only a 50% chance of a 25 basis point hike, and there's a 50% chance of no hike. So if they do hike by 25 basis points, you might see a short downside in equity markets. But this won't be the core thing. The core thing will be the forward guidance. So the key thing to look for is, do the Fed announce a pause? So if they hike by 25 basis points, but then announce a pause and start, looking at or hinting at cuts coming, then you can see equity markets move significantly higher. So if they don't hike at all, that's 50% priced in, but you'd see some reaction to the upside, but the forward guidance will be key. So if the Fed starts saying, yeah, we're confident that inflation is going to come down, credit risk is going to deal with that, we're really confident, so we're going to just press pause now and see how things are doing in 6 months' time, then you expect equity markets to rally sharply higher. That's what I'd say, Abraham. It's all about the forward guidance. Remember last December, they weren't necessarily expecting any rate cuts this year. But has that changed with the Silicon Valley Bank crisis, with the Credit Suisse crisis? And the other thing to watch alongside that, Abraham, is make sure there's no other central bank problems, not central bank problems, no other bank problems. If another bank is in crisis, then the Federal Reserve policy will become second fiddle and markets will panic and hit risk off. So that's the thing to be aware of for now. I think we're more likely to head into a recession now than we were 10 weeks ago for the US. Yes, it's more likely. Because banks will be more reluctant to lend money, and with banks more reluctant to lend money, that means companies will struggle and have more difficult financial conditions. That means they'll be less likely to take on extra workers. They'll be more likely to have job losses, and with job losses falling, then that means workers will be able to ask for lower wages. They won't be able to ask for such high wages. So there'll be deflationary forces, and recessionary forces will emerge. And when you have a credit crunch, you tend to then see a recession. So we're seeing a sharp credit crunch, and that typically precedes a recession. So we're much more likely to head to a recession now than we were 10 days ago. Yeah, got it. That's great, Abram. Good. It's tricky markets out there right now, and very much looking at what the Fed do, and very much looking at what happens with banks. They're the key stories to be on top of. If you've got those two stories right, you're on top of it. And if you want to see how the market thinks about those stories, look at the VIX. We start seeing the VIX move back below 23, 22, then that's a reassured market, and would expect stocks to move higher. Okay, folks, thank you all very much. Thank you, Abraham. Thank you, Ayman, Hashik. Good to have you there. Suneth. Any hint? Yeah, just use the VIX as the hint, because I can't tell, and it's just a bit of a coin toss at the moment. Will there be another bank that falls into trouble? What will the Fed do? These are some of the most uncertain markets that I've seen, like, for the last 2 or 3 years. Certainly since COVID, these are the most uncertain markets. So I'm just taking it one step at a time. All right, folks, thank you very much. Take care. Yes, these are on Monday and Wednesday, Eamon. You can arrange charts like this. Just, you can just see I've got stocks and VIX on one chart. Then I've got commodities on the other. Bond yields, the majors. Start with that. Then I've got index of individual currencies, which is helpful. Okay, folks, thank you all very much. Take care and have a very good session. Thanks, everyone. Goodbye.